I'd like to dig into some of the economic data from this week and some of the major markets with our next guest to get a better understanding of what's behind some of the recent price activity we've been seeing. To help us break it down, I want to bring in Bob Iaccino, the founder and chief strategist of Path Trading Partners. Bob's joining us live from the CME floor here today in Chicago. Bob, I'm curious, we've got CPI, PPI pointing towards very manageable levels in terms of inflation. I'm curious, how much impact, if any, do the numbers that we saw this week have on the Fed's decision next week?
Well, virtually nothing. And good morning, Ben and Kevin. Thanks for having me on again. Virtually nothing. I think what you're looking at now is when you see that CME Fed Watch tool, which is based off the Fed funds futures, get in toward that 90%, and you don't see any sort of disagreement with that from the Fed or Fed speakers, the March rate hike is all but assured. It would have been very difficult to have a CPI or a PPI weak enough to change this particular conclusion. It's been my opinion for a while that the Fed wants to get back to what they consider a normal level of Fed funds rates, and that's probably maybe 100 basis points higher than this. And it's more to be prepared for the next crisis. There's been several papers put out lately by different think tanks and different institutions that have said really it was the lower rates and not necessarily the quantitative easing that helped the market get back on solid footing, that helped the economy get back on solid footing. So the Fed wants to normalize. They do need to be careful, though, because there's starting to be a growing opinion that the U.S. economy had a run and has kind of slowed down, not to the point where it's contracting, but maybe that growth has sort of decelerated a bit.
All right. Hey, Bob, I apologize. We got to cut things short here, take a real quick break, but stick around because I want to continue this discussion and take a look at some of the numbers that are coming out. Traders will be right back in just a minute with more futures with Lichtenstein and Hinks. Welcome back, traders, and I want to re-welcome our guests back into the show here this morning. We're joined by Bob Iaccino, founder and chief strategist of Path Trading Partners. Bob, numbers just came in. We're noticing here that the housing starts, the building permits a bit lower than expected. And again, I'm curious your thoughts on those numbers in terms of market reaction.
Well, I don't think you'll see a whole lot, Ben. This particular set of numbers, especially on a day like today when we've got industrial production and Michigan sentiment, are kind of secondary. So many things can affect housing starts, which is, of course, digging into the ground, and building permits, the ability to get the permits to dig into the ground. It has a really weak correlation to equity market volatility specifically, but economic volatility as well. In terms of starts, it could be weather, it could be certain areas that have weakened, it could even be local governmental interference in these kind of things, which is rare. So it's really kind of a secondary number, but you still want to see it stronger. You want to see a trajectory that's pretty consistent up, and it's been pretty consistent up as of the last 5 or 6 iterations of this number.
Hey, Bob, is the major problem with this number today is January's numbers for housing and permits were so strong that it's hard for this number, which came in a little bit softer, to look good against those Jan numbers. Those Jan numbers were off the charts. Isn't, 1.23 million in the starts, 1.29 million in the permits, not really a bad number, right? Just not as good as January.
Right, and you had a 10.1 increase January over December.
Right.
And that's a great point, Kevin, because if you looked at the non-farm numbers, construction hires were huge. So a lot of that could be offsetting those particular building permits and those starts, and you've got to get these houses built. Again, so many things can affect starts and permits that aren't necessarily related to the strength or the weakness of the overall economy.
You're right. Good, very good point. I mean, Bob, we all know that these housing numbers, just for our listeners to understand, these housing numbers can be extremely volatile, week in and week out, month in and month out.
Yeah, so important to look at an average, not necessarily the individual weekly numbers or the monthly numbers. But Bob, let's bring this discussion on over to the metals a little bit. We've been watching gold. It's been very limited headed into the Fed. The only explanation I have for this is that the dollar's been very much range bound, and possibly gold traders are kind of taking on the position, I'll believe it when I see it, approach to the Fed raising rates this week. I'm curious, what are you seeing as far as gold prices as we head into the Fed announcement next week?
Well, I'm a price action trader, Ben. I think we've talked about this before, but I do like to have a fundamental case behind what I'm doing. So the way that I get into trades is I have an idea, and then I see if the price action matches the idea that I have, and oftentimes it doesn't. I don't get into a trade. Gold is one of those things, when I try and figure out a reason to buy gold, I can't find one. I mean, we're about to have a cup of coffee between North Korea and President Trump.
Right.
So that geopolitical sort of boiling kettle has calmed down a little bit. We've got no real risk of inflation, and really long-term, gold isn't a great inflation hedge anyway. It's perceived as one, but if you look at the data, it's really not. So we don't have an inflation reason to buy gold. We don't have a political crisis. We don't have an economic crisis. And we have a dollar that's kind of, it's been bearish, down about 5.3% since October of last year. But if you look at the Larry Kudlow effect, right, the guy who actually coined the term king dollar,
He did.
and who's saying let the economy rip, and he's the only one now in the Trump White House with the exodus of Gary Cohn, who's known as a strong dollar guy. We basically had Gary Cohn replaced by Gary Cohn, right? So he's the only one, and he's vociferous about it. And he seems to be able to treat President Trump in a way that he likes to be treated, where he might actually get some of his policy ideas through. So if you take the Larry Kudlow effect and say the dollar's at least going to stabilize until Trump overwhelms Kudlow and fires him, you've got a situation now where I don't know why you would buy gold. Certainly no reason to dump it, but I just don't know why you'd go long and wait.
Right. And, you know, when we talk about the metals, Bob, you know, it all goes back to the U.S. dollar. Now, we've been doing kind of an informal poll here as we run along in the show, and there are so many people bearish the dollar, Bob, that as a trader, it makes me nervous.
Too many.
Right? You're right, exactly
It's too
right.
many
So
people.
is that something that our listeners should pay attention to? If everyone's bearish the U.S. dollar, isn't that kind of a trigger that you should be at least respectful and careful of this move?
Absolutely, Kevin. And I'll tell you what, it's very much like overbought and oversold conditions, where the market can stay overbought and oversold longer than you can stay liquid. So it doesn't mean there's a turn. Like, it doesn't predict a turn, just like overbought and oversold doesn't. You can be overbought or oversold for a long time, and it isn't necessarily a reason to take the other side, but it's a reason to hedge the other side. That's definitely the way I'm doing. So I'm doing dollar hedging right now, and I'm actually slightly bullish the dollar. Again, I don't have a price action reason to get in the trade yet. I don't. But when I do, I'm going to get in with both hands, because that overbought and oversold, those momentum indicators, those sentiment indicators you're mentioning, way too many people want to be short the dollar. It's way too crowded of a trade. And again, the Kudlow effect. The difference between Gary Cohn and Larry Kudlow is Gary Cohn comes in and says, this is the right thing to do. And Larry Kudlow comes in and says, you know, you're smarter than me, and you're a great guy, and I really, really like you. I think we should do it this way, but whatever, it's up to you. That different approach works with this particular president.
All right, let's talk a little bit about copper, because the housing numbers, again, kind of weak today, but that's been the pattern for the most part. Now, I'm curious, when we're watching copper and we're talking about the range that we're seeing, are we going to need something out of China, some real robust numbers or some very weak numbers to kind of be that catalyst to break us out of the range? It's been tight recently, and for the most part, the housing here hasn't really supported the market or provided that catalyst to break us out one way or the other.
And again, Ben, you guys are great at telling your viewers and your traders exactly what they need to know. Base metals is the dollar in China, and that's all it is. There's very little seasonality because it's a global commodity. So when it's winter here, it's summer there, vice versa. So you're looking at the dollar and you're looking at China. And we got some good China data earlier in the week with that 13-month high on industrial production that I believe was Tuesday night to Wednesday morning. So we got that. We got a little bit of that good news, 3-year high in machine tool orders out of Japan, but too small of a copper buyer to matter. So if the global growth story comes back, I believe China's data is going to increase, simply because if their actual economy is not, they'll just increase it. So I think we're going to see stronger China data coming, and copper's going to react, and then it's back to the dollar.
Okay.
Hey, Bob, 5 days away from a Fed meeting. Obviously, this is Jerome Powell's first meeting as Fed chair. I think, like most people, that a quarter-point raise is a done deal. But are his comments, isn't that really what everyone should be watching for after they raise, which I think they will, his first real press conference answering questions? Is that what everyone should be watching?
That is always what we should be watching. Starting in about the middle of Janet Yellen's term, I've said this before, Janet Yellen was very successful at communicating what the Fed was going to do and then doing it. And if she didn't have a speech plan, she made sure that some Fed governor somewhere said something. So Jerome Powell is committed to improving. He's on the record saying, I want to improve upon that. So we're going to know when the rate hikes are coming. And I don't think Jerome Powell said anything in his testimony to Congress to dissuade the March rate hike. Jerome Powell has committed to improving upon the communication, and he's a more blunt person by nature, coming from private equity. So he knows how Washington works, knows how the private sector works. His comments are going to tell you what the next move is.
All right, Bob, let's talk about the rates here for a minute, because we were talking about the dollar. We were talking about a crowded bearish trade there. We've seen a bit of a crowded bullish trade, it seems like, here in the TNX. Now it's still holding below that 3% level, 2.83 last right now. I'm curious how you expect to see this play out over the next couple days, again, as we head into the Fed on Wednesday.
Yeah, super interesting dynamic developing there. You've got been really high put buying in the 10-year quadrant behind me. So 10-year options, we're seeing a lot of put plays, a lot of put spreads, a lot of outright put buying, very little call selling, and I think that's probably prudent. But a lot of insurance being put on, and we hadn't seen that in a long, long time. And as the 10-year went from 290 to 280, we saw it increase.
Right.
So I think that's sort of protection against inflation, but these particular prices, the particular pricing data you mentioned, the CPI and the PPI, didn't show it.
Right.
We didn't get it in non-farm, so the euro dollars are not reflecting that at this point. So I think that's sort of the play, is people are starting to say, okay, this could happen. We're kind of in a seesaw moment between whether the U.S. economy has kind of slowed its growth or whether it's just one of these pauses that tends to happen toward the end of the first quarter, beginning of the second quarter. Second quarter has generally been the weakest quarter since the crisis. So I think you're going to still see that insurance accumulation, but not necessarily a spike in those rates. So
10-year yield. This has got to be a frustrating trade for some people who thought the yield was going right to 3 and right to 3 1/4 so easy. Now, we were really talking about it a lot on this show, how we just didn't see that happening. It's becoming a little bit of a crowded trade, but not really surprising, right? It just doesn't go through a whole number like that so easily. So, but here is 2.8. Is 2.8 in the 10-year yield threatened here, right? You know, you're getting a nice little recovery. Now, Bob, and here's another thing, another part of this question. A lot of times we've seen the Fed move interest rates higher and bond futures rally off that number, right? Is that something our listeners should be at least cognizant of as they go into Wednesday?
I would be guessing, and I am guessing, that not a lot of TD Ameritrade users are trading that 10-year simply because of that frustration of the range.
Sure.
If you're a new trader, if you've been around 10 years, okay, you have not seen bond or 10 years really move. But you do need to watch it, because that just tells you a move from 283 to 3%, while not a lot in terms of ticks in the 10-year no futures, is a massive move. What's frustrating to me now is watching the ES get hit when the yields go lower, and then get hit when the yields go higher. So which is it, right? That's what's been happening lately. So it's really the frustration of the ES. I think one of the things you need to watch the 10-year note now is it's a factor in the mini trade, in the S&P mini trade, and the NASDAQ trade, more so than it is a factor in its own trade, if you can believe that. The 10-year is now acting as insurance policy for other things. And that makes its volume a little lighter, but it's important. Its importance is that much stronger to the side products that probably most of your viewers are trading.
All right, Bob, giving us a few things to keep our close eye on this week, and headed into the Fed here, as always is the case. It's great to have you on the show, and we were able to cover a lot of topics here today. Ladies and gentlemen, that's Bob Iaccino. He's founder and chief strategist at Path Trading Partners.